All right, today we are diving into a really specific accounting rule called IFRS 14. Now, I know that might sound a little dry, but trust me, this one is fascinating. It's a clever solution to a very unique problem. What on earth do you do when the government, not the free market, is the one setting your prices? Let's get into it.
So here's how we're going to break it down. First, we'll unpack this special accounting problem that these regulated companies run into. Then, we'll see how IFRS 14 was designed to be a temporary bridge. After that, we'll look at what old accounting habits it lets companies keep and what new presentation rules it makes them follow. And finally, we'll connect all the dots and see why this niche standard is actually a pretty big deal.
Okay, so the core issue here is really a clash of two worlds. You've got the grand idea of IFRS, which is all about creating a single global language for business so we can compare apples to apples. But what happens when you have a company whose entire business model is shaped by a regulator, not by supply and demand? How do you possibly fit that square peg into a round hole?
Let's make this real. Imagine you're running a utility company, let's call it Power Up Corp. A massive hurricane tears through, and you spend millions fixing your power lines. The government regulator says, okay, you can get that money back, but not all at once. We'll let you add a little bit to everyone's bill for the next 5 years. So the cash is already gone from your bank account, but the revenue is trickling in over half a decade. How in the world are you supposed to account for that mismatch?
Well, this whole setup has a name. It's called rate regulation. It's basically any system where an outside authority has to approve the prices a company can charge. You see this all the time with essential services. Think electricity, water, or natural gas utilities.
And that outside authority, that's your rate regulator. This is an official body with the legal power to set prices. Their whole job is to walk this tightrope, making sure prices are fair for you and me, the customers, but also high enough that the utility company can afford to keep the lights on. And all of this leads to this really critical concept, the Regulatory Deferral Account. This is the special bucket where our Power Up Corp puts that massive storm repair cost. Now, under normal accounting rules, it's not an asset in the traditional sense, but it's not a total loss either, right? Because the regulator is promised you'll get the money back. The best way to think about it is like a regulator-approved IOU from all of your future customers. So, you've got these unique IOU accounts that just don't fit nicely into the standard IFRS playbook. This is the problem, and IFRS 14 is the solution. It was created for this one specific purpose, to act as a temporary bridge, helping companies connect their old, local way of doing things to the new global IFRS system. And that word, temporary, is absolutely key here. This standard isn't meant to be the final word on regulatory accounting. Think of it more like a special on-ramp. It's designed to give these companies a smoother ride into the world of IFRS without forcing them to suddenly ditch the accounting methods their investors have been looking at for years. But, and this is a big but, not just anyone can use this bridge. The rules are super strict. You have to check 3 boxes. 1, you're in a rate-regulated industry. 2, you already use these special accounts under your old accounting system. And 3, this is the most important one, you are adopting IFRS for the very first time. It's a one-time offer, a single-use ticket. So, what does this special bridge actually let you do? Well, this is the give part of the deal. At its heart, the standard basically says, okay, for these very specific regulatory accounts, you can just keep doing what you've always been doing. And that's a huge exception. See, normally, under another standard called IAS 8, if there isn't a specific rule for something, you have to follow this very rigid top-down process to figure out how to account for it. But IFRS 14 carves out a massive exception. It says, you know what, for these regulatory deferral accounts, you get a hall pass. You can just keep using the rules from your old accounting system or what accountants call your previous GAAP. And you don't have to take my word for it. The standard itself is crystal clear. It literally says a company shall continue to apply its previous GAAP accounting policies. This is the big permission slip. It means all that history and logic can be carried over, which provides some really valuable consistency during a massive transition. But of course, nothing in accounting is ever a free lunch. This permission comes with a really important string attached, and this is the take part of the bargain. You can keep your old math, but the way you show these amounts in your financial statements, that has to change completely. So here's the deal, plain and simple. The standard says, Fine, keep your old accounting methods for those special accounts, but you have to present them separately from everything else. You can't just mix them in with your normal assets and liabilities. The goal is to make them stand out so there's absolutely no confusion. Here's a super simple example of what that looks like on a balance sheet. See how all the normal assets and liabilities get added up first, giving you a subtotal? It's only after that line that these special regulatory accounts show up, broken out on their own. This makes it impossible for an investor to mistake a regular asset for one of these regulator-approved IOUs. And it's not just the balance sheet. The same exact logic applies to the income statement. Any changes in those regulatory accounts throughout the year have to be shown separately from the company's core operating profit. Again, it's all about drawing a big, bright line between the results of running the business and the financial impact of the regulator's decisions. Now, this is where things get really interesting, especially for investors. This separation has a direct impact on one of the most watched numbers in finance, earnings per share, or EPS. First, the company reports its official EPS, calculated the normal way. Let's say that number is $2.50 a share. But that's not the end of the story. Because right below that, IFRS 14 forces them to show a second EPS number. Let's say this one is $2.35. What's the difference? This second number is the company's earnings without the impact of those regulatory accounts. This is huge. It gives investors an incredible tool to see at a glance the underlying performance of the company versus the effects of the regulator's timing. So, we've gone through all these special rules, this give and take. What's the big takeaway? Why does this all matter? Well, the whole point of IFRS 14 is to take a really complex and unusual business model and create a path toward clarity for everyone. At the end of the day, it all boils down to one word: transparency. By forcing companies to show these regulatory impacts separately, the standard gives investors a kind of dual vision. They can see the official, regulated numbers, and they can see the underlying operational numbers. That dual perspective is just incredibly valuable for making smart decisions. And it goes beyond just the numbers. The standard also requires a ton of disclosure of the notes. Companies have to explain exactly what they do, who their regulator is, and most importantly, they have to talk about the risks. What happens if customer demand suddenly drops? What if a new government appoints a less friendly regulator? This context is what turns data into real information. And honestly, this quote from the standard's objective really says it all. The goal is to help people understand the amount, timing, and uncertainty of future cash flows. And isn't that the point of all financial reporting? It's about giving people the tools to understand the future and the risks that come with it. So IFRS 14 is a really pragmatic, clever solution. It's a temporary bridge designed to solve a very real-world problem for a specific group of companies. But it also leaves us with a bigger, more profound question to think about. The fact that a standard like this even needs to exist shows just how hard it is to create one single set of rules that can perfectly capture the economic reality of every business on the planet. It's a great reminder that in accounting, sometimes the best solution isn't the perfect one, but the practical one that gets the job done. Thanks for joining me.